That's great.
Perfect.
Okay, so we're looking at your live charts are open at the moment. I know you'd like this to be an interactive session with
Yes.
people volunteering what Forex pairs we'd like to look at, what markets, what indices. But perhaps we could just start off with telling us what's caught your attention most recently. What you think has been maybe moving the most?
Well, I think, do you know what? There's a lot of things that are absolutely dead um, over the last couple of weeks. Currencies have been a real pain. You can see on the sterling there. Look, I mean, we've just range traded for quite some time. We're not really breaking up. We're not really breaking down. We're just stuck in these horrible range. And if you look at the weekly chart on this, you can see that there is potential, if you like. You can see these indicators here. They're telling you that, maybe all is not well. Maybe it's time for a correction. Now, that doesn't mean to say that we're not going to reach the target of 135.35. What it's telling you is that possibly now, not at the moment, okay? Because it's extremely overbought and it's turned. If you can see here, it's actually turned. So there is a case for people looking to sell now into sterling, and I think here is where we're seeing a lot of the action. As soon as you can see, you go up there, it gets sold off, it tries to get back up, gets up, sold off again, sold off, sold off, sold off. So there is this underlying fraction of the market that is really keeping it quite depressed, and it's holding above this little 20-day EMA here, but I just got this sneaky feeling with this that it's going to come lower before we go higher. And that's basically what the currencies are showing. We've had a big move up in the euro, but it's not following through, if you like. So
Is
yeah,
is
go
it
on.
the fundamental factors weighing on that? Do you think that we've already heard from a speaker this morning talking about the UK election that's looming? Are there any other factors that you think?
I won't, insult people by saying they don't apply, because of course they do. So there is that election thing. I mean, we saw it in the French election where the euro was pretty depressed until, but that was a whole different ballgame to the UK one. In the French election, one wanted to come out of Europe, one didn't. We're not seeing that in the UK election. It's the best of a bad bunch, really. So I don't really see how that's affecting the currency, although you will have some that will think that. They will think that that is what is affecting the currency, which is why we're at stalemate at the moment. I don't see it personally. I just think it's at a level where it doesn't want to, at the moment, go any higher or go any lower, and we just have to stay with it because you've got no choice, or you go on to trade something else. You look at across other things. You look at gold, which really isn't doing a great deal either. The stock markets have made a little blip higher. We've had the S&P overnight breaking up, but again, with anything like that, it's got to be on the cash market, not these spread betting overnight platforms, because they can go anywhere. But it will always be the cash market that will determine where we go, and if it opens up at current levels or a little bit lower, stock market's looking quite bouncy.
Just on a practical level, Carol, I think I might be correct in saying that you don't apply fixed sort of stop loss levels. Would that be correct?
No, we have to apply
You do.
fixed.
Sorry, I'm getting mixed up with someone else. Sorry. There's some people prefer to put sort of have mental stops, running mental stops, as opposed to.
Always, you always have your mental stop. I mean, the problem with anything, isn't it, is putting stops where stops are seen to be placed. So you do find a lot of guys out there who don't actually put them into the system, but they do run them in their head, and as soon as that level gets hit, you're out. But you should, you know, it doesn't matter where you put your stop. You can put your stop quite a way away, but that is to, if the market gets, you know, if it has a wobble or something comes out and it will run that far away from you, you need to put a stop in at some place at some point. But the idea of not putting them in too tight on a platform is probably the better way to play this.
Yeah, sure. Gordon's asking about the Dow. I know we'll go on to look at that, but for the benefit of, we've got quite a lot of new names here today, and it might be quite interesting just if you could just give us an insight into the sort of patterns that you would look in terms of a trade setting up. What would catch your attention on a chart, to give you the sense that...
I think what you have to understand is it's not just the patterns that you see on a chart. What all a chart is, for the benefit of those that are new, is it's just a chart of price action, right? So what you're seeing is supply and demand, you know. So over the years, you see these patterns emerge, and you look at the ones that historically have made the better trading opportunities. Now, personally, I like double tops, double bottoms, these little flaggy pennantly things that you can see there. They're good. Now, obviously, it shows you the direction, the idea of the measured targets that we get to now when it's sort of come up against a brick wall like it has on this double top. You can still get these measured targets. You just have to be a bit more flexible, because these days everybody's looking at them. So you've got the pennant here, you've got the flag here, you've got the double top, and this is all still within the uptrend. So you're looking for continuation patterns. You're looking for something that is showing you that the market is going to continue higher until you've reached this double top in sterling that's saying, well, hold up a minute, we might well still be in an uptrend, but at the moment, right at this very moment, this isn't a continuation pattern, this is a topping pattern. If you look at the old style head and shoulder patterns, that, I mean, they fail so significantly a lot of the time. So I don't really look at those anymore. I'm looking at, for example, right, you've got cable here. Now, if you ignore this bit, because it didn't happen, so you're looking at this bit here, you can see quite clearly that's the double bottom. It's classic, okay?
Yeah.
Goes up,
yeah.
There, goes down. That alerts longer term traders, because this is on a weekly chart, that the market is ripe for a move higher. It's going against what we've seen, the trend since what, 2014. Okay, this was the first stop. Even this bit here, continuation pattern. This wasn't a continuation pattern. This is a base pattern. So you could get, there's a lot of reasons you can give of why sterling went from 119 to 130, but the bottom line is it went there because at this point here, whoever was making the big decisions, and it's not us, it's institutions, hedge funds, God knows who, you know, whoever made that decision there that this was going to rally, this confirmed the view. It could have been, I mean, I can think of nothing fundamental that came out that stopped sterling. In fact, at the point of this here, okay, I was looking at it, it was over a weekend, that happened on a Sunday night. Every piece of news coming out about sterling was negative, but something made it, you know, reverse and trade higher. You can't ignore this. You have to be on the back of this. You know, you can see where it then went up to its first retracement, come back down, intersected at these trend lines, and up we've gone again. all we're doing now is we're just going sideways, but you've got to remember that you've got this double top pattern here, and unless it gets above it, unfortunately, sterling's going to take a cold and it's going to come down before it goes up. But nothing's really changed in it. It's still looking, you know, you can see where it stayed in the uptrend, and it's been looking really good since it broke up above 121.
Indeed. So it's the combination of the Fibonacci levels I see that you have overlaid on the previous chart.
Yeah, I do look at Fibonacci levels. I mean, I know there's a lot of people out there that go, do you know what? They are a complete waste of time. But, you know, they're not. Look, here's our Fibonacci level yesterday, 129.22. Allo was 129.25. You know, even if you don't agree with them, even if you don't look at them, you're pretty unwise not to take notice of them. I think where a lot of people come unstuck with these Fibonacci levels, they don't put them in the right place. So therefore, they assume that they don't work. And it's not that they don't work, it's that you're not in the right place. If you put them in the right place, you know, you'd be astounded at how many times they do work. You know, I've looked at them for over 30 years, and they still bring a smile to my face when they get down to a Fibonacci level. And they're not at every point. You can see, you know, they're quite spaced out. You've got 22 there, then you've got, you know, 128.45. So they're not very close together. So you can't even use that argument, or they're going to hit a fib level at some stage because they're so near to each other. They're not. They're actually spaced out. So, but to say, if you put them in the correct place, they're a very good trading tool. They really are.
Could you just remind us where the right place to start? Since you mentioned it, I know everybody's thinking it.
Okay. Well, what I do, look, you've got this. This is on a 4-hourly chart. So I want to look on the bit where the market started to absolutely motor higher. So I've took it from that point there. Okay. Now you can play about with them, but what I do is I take it from the point where the market actually started its big move. You can take this one as well, which, I mean, I've took a lot off because I didn't want loads and loads of lines everywhere. But if that one is too far away, for example, which that one seems to be, you just take it off and you take it from the point from where the move started, and it started here. You can see where it just motored away, and
so that,
then go on.
Yes, so that's a significant thing, is identifying, looking back on the chart to identify the start of a significant move, trend.
Yeah. I mean, it doesn't even have to be a significant move. What you have to do is you have to take it from the place where the move was first obvious. It doesn't have to be, you have to connect either a low and a high, you know. So I can't just put it, you know, if I'm taking it from here, I can't put it here, for example. I've got to put it to at least a high or a low. But where you start it from is basically common sense and looking at it and going, well, do you know what? Look, it started from here. So it started from here. So therefore, that's where I'm going to take that. I want to see the retracement from that bit. I don't want to go back to. You put your Fibonacci levels on longer term charts where you want, you know, on the weekly chart, I've taken it from the high to the low. That's how I've got these. But when you're trading intraday or shorter term, you really don't want to see the whole of the move up. You want to see what portion is relevant to your trading time frame for that particular instrument.
So in fact, you want to be trying to second guess where everybody else will be placing their Fibonacci's, because they're sort of self-fulfilling and take into account that human.
Say they're self-fulfilling. If they were that self-fulfilling, there wouldn't be an awful lot of people out there getting them wrong. So it depends on where you put them. That's the problem. It really does. I mean, as I say, people will say to me, they don't work, they don't work. Well, we know they do. You know, I know they work. I know it's where you put them that's the problem. It's not the actual Fibonacci levels themselves. And you know, you've got very, very short-term traders looking at a 5-minute chart. They're not taking the whole of the move. They're taking from a specific bit that they're interested in. They're not wanting to see the whole of the move up. So you've just got, it's, you know, trading's all about common sense. It really is. I know people want to read lots into it, and there is a fantastic system out there for doing this right and do it. If you just strip it all back and use basic common sense, you'll find you'll get ahead a lot easier than trying to, you know, I don't second guess where others are putting their Fibonacci levels. I put mine where I think they should be, and they work. So I'm not the only one doing it, obviously. Probably all the people I've trained over the years are all doing it the same way. I don't know.
Well, you mentioned that, Carol. How are the courses going? You've been doing some sort of mentoring and residential courses
Yes,
recently.
I have. Yes, I have. It's difficult because, you know, everybody's at different levels. They and look at markets different ways. I'm finding I'm not trying to bully people. That's not what I'm about. I'm not bullying at all, though probably the last class will tell you I am. But you've got to get them to look at the market, you know, in an easier way than they're looking at it. I'm getting people coming in and they've got, you know, reams and reams of stats and various trading strategies that they're looking at. And, you know, I try really hard to go, okay, let's get back to basics. And I think that's got to start. I mean, I think hopefully they're going well, but there are a lot that are coming in with a lot of preconceived ideas about how a foreign exchange market or a equity market should follow a pattern. It should follow this. It should do this. It should. Well, they don't. You know, yes, they are ordered. I like to say that there is there's organisation within what seems to be a chaos theory.
Mm-hmm.
And I think that's the problem. You're trying to apply too many variables to a market that really is quite simplistic in the way it moves. And that's my biggest problem, is trying to get people to basically ignore everything they've learned and start again. Now, I'm being told, you know, well, it can't be that simple. I'm not saying it is that simple. I'm saying if you use the simple approach to looking at it, you will get further forward than trying to apply all these different mathematical strategies to a market that really is not a mathematical strategy type market.
Mm-hmm. Algos have made the market choppy, Yat is saying. So.
Algos have been around for years now. This isn't a new thing. You know, even in my days back at Midland Bank, we used to call them black box systems, that we used to have teams of guys doing it. Algos aren't new. We've always fought algos. They've just got more, what's the word I'm looking for? They've got more clever, I suppose. Don't forget, an algo is only what somebody programs it to do. It's not. It doesn't think for itself. It's given a set of parameters, and it works within those parameters. Now, if you look at, like I do, because I've got quite an interest in the algo programs, you know, most of them break even. So they don't know everything. That I think they're just invented to trip up traders. That's what I think.
You might well be right. Oh, Carol, could we go across and have a look at the Dow? One or two other people have come in, so that's something they're looking for.
The Dow, I mean, it's not broken up at the moment. The level it's got to break up is 21,169. That's what it's got to break. Okay, that's its previous high, and that's what it's got to do. Now it has tried, I'll give it that. I mean, it really is, but we're not exactly bound in a way, are we? We've got the S&P that has broken up overnight, but it's whether or not the cash can sustain it, whether or not it will actually open and hold this level. I think we're trading now about just under the 121.78 we're at now. So we are sort of just below this line here. When I'm sharing my screens, the pointers are really bad. So you can see where we've got to break up above. We've got to break this level here, which is 21,169. If we can do that, then obviously the Dow's in a better position. If you take a look at that weekly chart, you can see really most of this year has just been a complete utter mess. Like since February, it's just sort of up and down and up and down. But basically, if you look at that, it's gone sideways. Now, it's gone sideways within an uptrend. So this sideways, I think, is a continuation pattern. There's nothing out there at the minute that is telling me that the Dow has topped. Not yet. If it gets to 21,150 and stops, then obviously I'll have a look and reassess it. But you know, all the indicators that are coming out, they're not really being able to give you a clear direction. It's just the Dow sideways, and until that changes, you have to stay within that. We've got a swing level of around 2,900 to 2,850, and that seems to be, if it goes below there, it goes lower. If it stays above there, it goes higher. It's that sort of thing. All the Fibonacci levels that I've put on this market, we have, in actual fact, if you look at this one here, let's get those off. We'll take them off. You know, this is the bit we were interested in, or I was interested in. And you see, look, we've come down to that 23.6 fib and gapped up, come down, filled the gap, gapped up, filled it. It's retraced 23.6. So I can not see any reason why we can't try for that 169 area. And if we break that, the continuation pattern that you can see quite clearly on the weekly chart should take that quite higher. I mean, you're looking at the Dow coming up to here, you know, 2200 and then 2320. It's not beyond the realms of possibility, and that's without even taking the measured target off of it, which is, you know, propels the Dow to quite high levels around the 2500 area. So I think with this particular market, all you do is for the moment, you're just buying into dips. Easier said than done when the thing tanks like it did last Wednesday. You know, there was no clue at all in this bit here that we were going to have this sort of move last week, but we recovered. It hasn't had one day of, you know, ever since then, it's just gone up. So logically, you know, what can't go down has to go up, really, doesn't it?
Sorry, I'm just looking at the questions that are coming. I'm trying to see the most popular thing that's being requested. Do you have any thoughts on the euro? I know that the DAX is not your favourite.
It's not.
From recent, but what about the euro? Any thoughts on the euro? You might have mentioned that already.
Yes, I mean, let's just call that up. It's obviously easier if I bring them up so that you can see.
Mm-hmm.
So look, here's where we made the break. Okay, we've made that break. You can quite clearly see that break higher. Okay, so then we've got the second one. just done it this week. We've broken up this week. But look, it doesn't want to go up. It really doesn't. It's double topped. It's rounding topped. It's all right. We've hit the first fib level. But, you know, all these indicates, everything we're seeing is not saying the euro is looking particularly strong at the moment. You know, we are extremely overbought on across all time frames. It's not just the dailies and the weeklies, you know, even out to the, you look at the weekly, see it's turning there. Yeah. I can't see any reason at the moment at these levels to rush out and buy it. I think we should have quite a good correction first. And I would think to come back to, and this is where I would put my Fibonacci's, I'd put it on this bit here and say, right, well, that's where I think we're going to come back to, between that and that. And also, if you just don't look at Fibonacci's, these are how they all tie in together. If you just don't look at them, we know that that level there was the break point of 1025, and you've got the 50% fib coming in at 1050. We know also that 1035 was the level from a previous lifetime. So around that 50 to 25 area is quite a good area for the market to come back to, and for it then to continue to move up. But I think at the moment it's run away with itself a little bit, and it's got a bit too overcooked on the top side, and this is what we're seeing. We're seeing it struggle. So I'd be very wary about rushing out and buying it until we've seen that quite good corrective move lower.
Mm-hmm. Carol, when you say overbought, do you mean that, are you looking at the stochastic levels, Gordon's asking?
It's the stochastics, the RSI, anything that shows you whether the market is overbought or oversold, really. You can use any of them. I use the RSI and the stochastics because I find that stochastics especially, because they incorporate the open, high, low and close of that particular bar you're looking at. So be it a 4 hourly, a 1 hourly, a daily, weekly, whatever, it takes the whole bar. And if you put that on a 10-3-3 basis, you get when the market is running out of steam. Although the price action might look strong, these stochastics actually tell you, well, hold up a minute, we could be seeing the turn, which is what we're seeing in cable and the euro at the moment.
Fantastic, thank you for that. But does anybody else have comments on the euro before we move off to look at another stock? The FTSE being mentioned a couple of times. Have we looked at the FTSE already at the start, or?
No, we didn't look at FTSE. Do you want to look at FTSE? Is that the one you want to look at, Simon?
Yes, please, yes.
Okay, with anything, what you should always do is you take a look at the longer term time frame charts first. Okay, so you take a look at the FTSE and you go, right, okay, well, we're not actually, where are we? So we look at the weekly chart, still in an uptrend, nothing new there. Go out to the daily, still in an uptrend, nothing new there, but there's levels we have to clear. You know, we have got to take out those highs. We have no option. Can we do it at the moment? Well, if you look at the stochastics, they're actually down. They've eased from that where it was extremely overbought, and it came down, didn't really do any damage on the downside, and we go again. So the market is well placed, to be fair, to take those highs out, but it's got to do it, and it's got to do it in the cash session. I think this is, when you're trading the FTSE, this is a really big, huge problem, I think, is if you're trading outside of the cash hours. Years ago, you didn't. You weren't allowed to trade outside the cash hours, you know. So the market closed, that was it. It didn't do anything until it opened the next day. Now it can go anywhere it wants, but the actual volume and the thing that will move the market is the cash. So I do all my analysis and all my trading only based on the cash market. I don't look at it outside of hours. So you have to know where this is, and this is at 35, okay, 33, 35. So that's 75, 33, 35. So we've got to break that. And as you can see this line here, if we can do that, then we can stay within the uptrend and trade a lot higher. Looking at that weekly chart, there isn't really anything that detrimental to it. I mean, it's looking, whatever way you look at that chart, it's looking quite sexy, really. It doesn't seem to want to go down. It's not overbought. All right, it's at higher levels, but you're actually only looking for a turn. If you look at the RSI, the weekly RSI, it's not overbought at all. You know, it's only if we start to go above 80% that there is room for a change. What you're looking in these indicators are for them to start to turn. That alerts you, not while they're still pointing higher, and they're still pointing higher at the moment. So if they're still pointing higher, the chances are we're staying within this channel here, and we're going to go to the top of this channel here, and that channel comes in this week. Well, I don't expect it this week, but if you just follow it out, you're looking at 76.35, 76.40, 76.60 as the weeks go on. So you can define just by eyeballing that, you can see that it's in an uptrend. You can't not see that. But what happens is when markets get away from themselves, so they start to accelerate within their direction, you do get these pullbacks. Well, we've seen this from, you know, the middle of last year when you saw that FTSE base there, that head and shoulder base there. You knew pretty well that once it broke through, which seems quite funny now, but once it broke through 63 and a bit, it was going higher. Whereas here, we're calling for FTSE to go to like 50, 4,800, 4,500. You couldn't find anybody who wanted to buy it. Now, you know, it made that pattern, it reversed, and off we've gone, and we've stayed bid for like 18 months. It's not, you know, it's been, well, not 18 months, but a year at least. We've been in this uptrend for a year nearly, so stay with it. Why not? It's just that when it gets to the top of its range, you don't want to be buying unless it breaks. So at the moment, there's no reason to think that FTSE isn't going to break higher. But as I say, it needs to clear this bit first, and then we can. As soon as that breaks 75.40, you will see buyers coming in. And I think what scares people is they think, well, why do I want to buy the top? I hear that all the time. Why do I want to buy the top? Because that's what makes markets move, you know. You're not buying the top, you're buying it. You don't want to buy it at 33, agreed, but you do want to buy it on a break of that, because that suggests that we're going to go to here quite quickly. So that's why you buy a break of recent, especially when you're at all-time highs, which we are.
Fantastic. Thank you. Okay, one or two questions come in. I suppose it's always there, the Aussie dollar and the Japanese yen.
Well, the Aussie is going to follow gold, right? That's a commodity currency. So really, that's a gold play. Gold goes higher, Aussie's going to go with it. It might take a couple of days, but it will do it. As for the dollar yen, as you all know, dollar yen is a stock market play. You know, that's what it does. If the dollar, if the S&P is trading higher, dollar yen will follow. It really is that simple. So you have to look at these market correlations, which I don't think a lot of people look at.
That's interesting. Yes, the people are maybe too narrowly focused on the pair and the technicals, and not taking into account these big fundamental impacts.
Well, as I say, I'm no fundamentalist. I just know that you've got, you know about the risk on, risk off trades. You know, Aussie is very closely correlated to gold because it's a commodity currency. So if gold is going through the roof, the Aussie isn't or shouldn't puke. It should go the same way. So if you are trading that, it's like people trade sterling and they trade the euros, and nobody looks at the euro sterling market. I find that quite difficult. If you're trading to outright majors against the dollar, you have to look at what the spread's doing. You have to look at the euro sterling, because you know euro sterling doesn't stay the same. You know, it moves, and they all move. All these markets do have intermarket correlations, and if you want to buy the euro and the euro sterling is looking like it's not very good, then it alerts you to maybe the euro isn't going to go up as fast as I think. Maybe it's sterling that's going to go up a lot quicker, and vice versa. You know, you need to keep your eyes on other things that affect the markets that you're trading, and I don't think that too many people do that, which is amazing because euro sterling is a big market by itself. And we've seen Aussie, you know, as soon as that gold started to turn, Aussie was with it and went the same way. Now, sometimes it takes a couple of days for it to follow through, but you've got to keep your eyes on these things. You must, if you're trading one thing, not become too focused, too, Aussie's going to do this because of, well, look at gold, and if gold's showing you the stats, that's the way it will be, fine, but you've got to look at these other markets.
Mm-hmm. What would you advise? Because some people, they advise people to follow the institutions insofar as they will have their special desks where the analysts learn everything they possibly can about one particular currency or stock market, and very much specialize in just that area or that currency or that market. That sort of, for most retail investors or traders, I suppose it's easy to try to sift through all the markets looking for that perfect setup for a trade. Would you think that's a mistake, to be trying to spread yourself too thinly, looking for patterns across all the pairs, or should you look and study and learn one particular pair and get to know its cycles and all the fundamental political things that can have an impact on that, so you're ready to take advantage when the opportunities come?
No, not really. I wouldn't say to look at one particular market, to be fair. I think you can quite easily take on board 4 or 5 markets. You know, you've got to, I mean, all currencies, unless they're intermarket currencies, but all currencies are based on the dollar. So you've got to have some sort of general idea about what the dollar's going to do, you know. I don't look at figures, as you know, but I was there for FOMC last night, and I look and I think, you know what, that weren't bad news for the dollar. In fact, I thought the dollar was, you know, should go higher. Totally the opposite. It was the currencies that went higher. So you can know, you can be in the market years and years and years and years, and you still get these fundamental things wrong. I'm no fundamentalist, but what came out last night didn't seem to me to be bad for the dollar. But obviously currencies are in an uptrend, and that's the thing, okay? If you go back to when I very first started trading, I was a fundamental trader. God forgive me, but I was. And every single piece of news that came out was negative for the bond market. That went up. It just went up. It didn't matter what came out, it would dip down a little bit and then go blasting higher. That taught me that whatever the market as a whole was looking at, it wasn't looking at these economic figures, because they didn't work. So although you can have a broad outline or outlook on what you think the dollar's going to do, you know, even us professional traders, we we can get it wrong. And the reason it's getting wrong is these currencies are in an uptrend, and it doesn't matter what the dollar's going to do until something tells you they are not in an uptrend anymore. You're going to get people buying dips in currencies because it's like a load of sheep following chief sheep. It goes up, and then they all jump on board. You know, institutions aren't any different. We don't have, or we didn't have, huge teams of research people. You had me and a couple of others that were looking at currencies across the board. You know, we were saying well, back then it was dollar mark, but for example, where dollar mark was going to go, where dollar Swiss, dollar yen, you know, there was about 5 or 6 of us that covered the whole of the dealing room, and we traded our research ourselves. We didn't not trade it. We did trade it. So you don't have these desks of people doing research, I don't think, anymore. The retail market can quite easily handle 4 markets, I would have thought, to have a look at. I mean, I look at a lot more, and I mean, I miss things because it's quiet for me at the moment. It's not doing a great deal, so I'm not as focused perhaps as what I should be. But I think if you're a retail trader, you can quite easily look at 4 or 5 different markets. You know, why sit there glued to a euro? You're missing so many more opportunities by broadening your outlook and looking across different markets.
Mm-hmm. But still, maybe 4 or 5. I mean, I think there's something to be said for learning a market, and maybe perhaps not
difficult to learn. I mean, it would be like somebody saying to me, "Well, learn the euro or learn the dollar mark." There's nothing really you can learn about it. There's only so many figures that come out, and the figures you've got to imagine is they're all a month out of date, so they're already priced into the market. So unless you get a really wacky figure, it's already in there. Don't think for 1 minute that the German banks don't know what the German figures are and the Swiss banks don't know what the Swiss figures are, and vice versa. I'm here to tell you they do, because their major bank, their central bank, are not going to let the German banks not know. I mean, or should I say, but you know, at the UK clearing bank I worked at, we knew the figures. We knew what they were coming out as, because they can't have you stuffed around the wrong way. It's not in their interests. So unless the figure is way out of line, it's already priced in. It's a month old.
So are you trading these events, or do you watch them but just trying to avoid trading the actual event itself?
I like trading over it, only because I like to pit my wits against what the rest of the market's doing. I quite like trading over figures. I always have done. Nothing to do with the figure. It's to do with the fact that it might make it move in the direction I think it's going to move. I used to love trading non-farm payroll. I can't be bothered with it now because it doesn't move. You know, we're beyond non-farm payroll now. It's now looking for something else. It's now looking at FOMC, which, as I said, was a damp squid last night. So you're better off not learning about all these economic figures, to be fair, because to be honest, they don't really help you in the day-to-day trading. And that's, you know, at the end of the day, whatever way we're going to dress it all up, the end of the day, trading is about making money. It's not about knowing how many figures do what and what it means and blah, blah, blah. It's about, if you bought at 25 and it goes to 75, you're happy. If you buy at 25 and it pukes, you're not happy. It's that simple. And you can only get that by looking across the markets at the different time frames and looking what the price action's doing. I mean, all it is supply and demand. You know, we know the currencies are in an uptrend. Therefore, even on a figure that makes that come down, it's still going to be bought back up because the market is thinking currencies are in an uptrend. Now, unless you get your head around that, you're going to come unstuck. I'm not saying you can't sell short currencies. There are levels where you can, you know, where you are scalping, for example. I don't scalp, so it's out of my, you know, spot traders do that. It's not what I am all about. But you can take a short position in an upward market, but you're leaving yourself in a far riskier position than you are going, it's in an uptrend, we're buying dips, because that's what the rest of the world is doing. It's waiting for these pullbacks to buy it. It's not waiting for it to go up to sell it, because it doesn't look like it's going down. So until you see a top, you know, like you've seen in cable, for example, you've seen a top there. So of course you're going to get people going. But remember, doubles hold, triples don't. So it's probably going to be, you've had that now. The next time it gets up there is the time it's going to break. And you'll still see these people selling it. And that's where they'll come unstuck. And it'll be self-fulfilling, because those poor souls that are short up there thinking, why not? History repeats itself. Yes, it does. History does repeat itself. But there is also other factors to factor in. There is doubles hold, triples don't. We know that as people have been in the market for years and years. So we're aware of that. So we're not going to be selling up at that level anymore, because the chance, the high probability is that it's going to break and to continue to go higher. I mean, if you look at 4 or 5 currencies, there are trading opportunities every single day. There really are. But if you focus too much on the euro, I mean, I've got guys that just trade FTSE and get very frustrated when FTSE doesn't do anything. You know, they get very upset and they stick buttons out there, out the pram and whatever. But, you know, if it's not moving, look at something else. Go look at something else that is moving. You know, pick some favourites out. I suggest that people look at 3 currencies, gold and the stock market. Then you get a broad picture of what the world is doing, rather than just being euro focused. Does that make sense? It does to me, but
it does. It does. Does anybody else have comments or questions? We're just down to the last few minutes with Carol.
I really don't feel well.
You've battled on very well. Thank you. you sound good, if that's anything to go by. But well, Carol, I think we will let you go then.
Thank you.
Thank you very much for joining us again, and hopefully you'll feel better soon. I know everybody's wishing you well. Hope you feel better, Carol. But we'll keep in touch, and we'll hopefully hear from you again in the future.
Okay. Bye, Simon.
Okay. Many thanks indeed.
Okay.